it would be unprecedented, okay, for proper bear market, which is being driven by earnings recession, which is our core view, for the equity risk premium portion of the PE multiple to not have spiked. The question is how much is the availability of capital going to go down? How fast is that going to be, and can that lead to a recession like immediately? And I think the answer is, well, the risk of that's gone up. I don't know. But now it's possible that that's been impaired. That's my biggest concern, is that I'm not sure what it looks like on the other side of this recession now, whether it's this year or next year. You know what I mean? And can they actually, the velocity of money may be permanently impaired. And if you can't do QE and use the Fed's balance sheet, then how are you going to actually, get this thing restarted?
We are really delighted to have Mike Wilson with us today. Mike, how you doing?
Good to see you, Bob.
We've had a number of speakers on that cover really fun topics. And while most of the time when you're talking about near-term market trends, and we'll cover some of those. I also like to get some perspective, your thoughts on where do we sit in today's world relative to what it's been like in the past and what might lie ahead, thinking in terms of decades rather than months. And I guess why don't we start with that? Where do we stand? It seems the central banks have been so accommodative for so long, really the mid 80s, that it's probably created a whole world that is unlike anything in the past. And kind of curious what you think about how it all unfolds.
Yeah, as you know, this job requires you to kind of predict what's going to happen tomorrow. But the fun, more interesting part of the job is also trying to figure out the next theme. What kind of regime are we in? And we spend a lot of time on that, as you know. We're what I call cycle analysts, not to be misconstrued with psychoanalysts, although sometimes you feel like that. And we've been fairly adamant about the period that we're in now, really for the last 5 years. So even going kind of pre-pandemic, we thought we were kind of running towards the end of financial repression, meaning you had kind of done it, you had run that story that you just said for so long that you really couldn't go any further. Okay, you had, I think it was $17 trillion of negative yielding debt at the peak. Interest rates were zero basically at all the major central banks. Quantitative easing programs were going on still in some form or fashion. And look, monetary policy, like extremely easy monetary policy, ironically, is deflationary. So it's almost as if, they were giving the patient the wrong medicine. Central banks have been trying to get inflation now for the better part of a decade or two, in the case of Japan, 3. And the policy of easy money, actually what it does is it makes it worse, because you keep a lot of zombie companies in business. You don't create any real velocity in the real economy because, there's no incentive to invest real capital, right? There's the incentive is there to borrow money at a very ridiculously low price and then use that to buy back stock or do other financial engineering, be it M&A or other types of activities. And of course, neither one of those is going to get you the inflation and the velocity in the economy that they were kind of striving for. So as we were entering or exiting 2019, and really as early as 2018, we were saying, look, the next recession will lead to a change towards more fiscal policy. And that will be what essentially breaks us out of this downtrend in rates. Of course, we didn't anticipate a pandemic. But of course, when the pandemic hit, we were like, aha, there it is. It's like the perfect setup now, because we have the excuse or reason for why governments will now spend money irresponsibly, which is required to break yourself out of that financial repression trap. And oh boy, did they do that, right? So, and so here's an interesting tidbit. After the GFC, we did QE, and gold went up for a period of time. As you recall, people were like, oh my God, this is going to lead to crazy inflation. Of course, we never got the inflation. Why? Because the money never got into the economy. It sat on bank balance sheets. It was dead money, and it was just filling holes. But this time around, what did they do? They sent checks, they did direct deposit, they did PPP loans. They found every which way they could to get money into people's hands. And of course, as you know, if there's one thing that Americans are really good at, it's spending money. You give them 50 cents and they'll spend $2. So that's what happened. And that's why we have inflation. By the way, that was by design. But the problem is they did too much of it. They did, I would argue, we probably did, the last two fiscal stimulus packages were completely unnecessary. And that's not really a partisan comment. You can say it was, but whatever. The point is that we didn't need it. And that's really when money supply growth went to 21, 22, 23% year over year. We've never seen anything like that. And that's why we have inflation. So now the good news is that we're on the other side of that. M2 growth is now negative, and we're probably going to get disinflation or deflation later this year, probably recession, who knows. But it's a long answer to your question, because I think that setup is important. And so the period that we think this is most similar to, we've talked about this, is the 40s. That was the only other time we had financial repression like this on a global scale, where interest rates were basically managed, yield curve control, whatever you want to call it, where we orchestrated negative real interest rates in the teens, by the way. You think, real rates were even more negative in the 40s. And I know you know some of this, but it's good for the listeners to get the history. But World War II was like COVID, or COVID was like World War II, right? World War II was the mechanism by which we finally got out of the Great Depression and that financial repression, because what it did was it built up a bunch of savings that couldn't really go anywhere. And then, of course, when the GIs were sent home and the war was over, all of that money got unleashed into an economy that wasn't ready for it. So people will talk about, still today, people will say, oh, we had inflation because there were supply chain problems, we had supply shortages, and it was all the Fed. That's totally incorrect. We had inflation because we had too much demand, and we had logistical problems. They were making plenty of stuff. It just couldn't get from point A to point B. But of course, that's now all been resolved, and now we have too much stuff. So what it leads to, and this is really the punchline, it leads to a world of boom bust, okay, hotter but shorter economic cycles. And we predicted this back in 2021, that the average economic cycle now would be about 3.5 years, and we would repeat that cycle probably for the next 10 years. And so here we are in 2023, exactly 3 years after the new cycle began, after COVID in May of 2020. And I would say we're right on track. I would say we'll probably have a recession this year. It's not a house call, it's my view. Our economists are 50% chance, so it's not like they're zero. And I think everybody's kind of in the, higher than normal probability. So right on schedule. And what that means as an investor, and also as just a person in the economy, is that we're not going back to the way the world was. Okay. And what I mean by that is, we don't have unlimited supply now of capital. We don't have unlimited supply of labor, because we can't outsource the way we were doing. And we can talk about why that is. And we don't have unlimited supply of energy, because we had this fracking miracle and excess capacity in OPEC. And now, sure, if you think about an economy, right, the three most important inputs for an economy: cost of capital, real cost of capital, labor, and energy. And for the last 30 years, we had a monster tailwind on all three, which is why we had this sort of, fly for financial asset that's, phenomenal. But the economy really wasn't that productive, because we weren't investing in anything real. Yeah, we had some technology investment, we did some fracking, okay, things like that. But generally, we've underinvested for 15, 20 years. So what does that mean? We have very low labor productivity. And as you know, productivity is the key to a successful economy. If you have 2% plus productivity growth, like we had in the 90s, for example, that is nirvana. Everybody wins in that kind of an economy. Labor wins, capital wins. You get some really cool inventions. You find out how to do it. And so that's the period I think we're going into now. It's riskier. People think that's less risky. It's actually, of course, it's riskier, right? It's risk capital is not going in. Like if you're a financial, participant, and you can borrow at ridiculously low rates, I mean, you don't have to be very good to make money, right? You just, prices go up over time. So now, and by the way, operationally, companies had it really easy too, because all the economic variables were easily predicted. They had excess supply of labor and energy and all these inputs and cost of capital. So, it was much easier to be a successful company in the last 30 years. Now it's going to be much more competitive and creative destruction. So I think there's two stories going on. A, we're going to have more frequent recessions, so more cyclical in that way. You need to figure out how to time that. Secondly, there's going to be more competition within industries. So the way we like to think about it, like the good operators will be rewarded, the bad, sloppy operators will be punished. So there's a great stock picking opportunity too. And it will be a more democratic society, meaning it won't be the world of 1%, not just in terms of individuals, but also corporations, right? So the last 15 years, the five stocks have made up whatever 70% of the returns, and that's basically five stocks is 1% of the S&P 500. So the 1%er applies not only to individuals, but also corporate America. And I think that's a good thing, Bob. I think, you'll get a redistribution of income from capital through the labor channel, hopefully this time, not through, distribution of checks for not doing anything. No participation trophies, right? You have to do something for the money now. But that's good, because that means a real wage can be earned. And that creates a good flywheel for the economy, but also at the corporate level, right? You think about, really can't mention individual names, but you can imagine the biggest winners of the last 15 years. A lot of those guys were enormous beneficiaries of the cost of capital being negative. Those businesses would not exist if we didn't have negative real rates. And those businesses have hollowed out middle America, right? They've basically made many businesses obsolete. Now, as a consumer, you might say, well, I like those things. I like getting stuff delivered to my front door for free. And I like not really paying for it. I like being able to call a cab on my phone at a discounted rate. It's wonderful. I like
having food delivered to your house.
Yeah, I like having, endless amounts of entertainment at my fingertip to stream on my TV. Fantastic. But somebody's got to pay for that stuff. Okay. And those business models really, in many ways, don't work when a real cost of capital is, imputed on their businesses. And so what that will do is it will reopen the door of opportunity for other businesses to do those same activities or different activities, and have to invest and do things maybe differently or in a way that is good for the consumer and they're good business models. So that's probably my opening salvo. I'm not, people think of me as always being bearish. It's not true. I'm actually quite bullish many times. And I'm actually very bullish once we get through this, finishing chapter on what this end of cycle looks like, because I think it will be much more rich in individual stock opportunities than what we've seen for the last 15, 20 years.
Yeah, there's been a stability that prevented the weaker from disappearing, and that discipline back into the market should be it should allow for greater flexibility and mobility, the labor force. If we look at labor productivity, what technology seems to be a driver of that in waves throughout history. And it's always been very difficult to predict. You spent a big portion of your career focusing on technology. Is that going to be one of the keys going forward?
Yeah, we're very bullish on sort of the secular trends in capital spending broadly, and that includes obviously technology, whether that be compute power, software, all the things that people think about in terms of real tech spend. I would say, first of all, in the 90s, as you know, we had a productivity revolution because of technology spending that benefited the entire economy. So, for example, the internet, right? We all got Netscape on our desktop, and we had this thing called email. It was like a new toy. Okay, but maybe the single biggest productivity, improvement in history of, white collar jobs. I mean, without question. And so the 90s, this internet revolution really increased the productivity of, like I said, white collar workers, which is what the U.S. economy is. And that was enormous. And it was very prolific, and it was very broad. I would argue that the technology spend of the last 10 years has not done anything for productivity except for the companies that have used it to create monopolies. And we know who those companies are, whether it be in, like we mentioned before, delivery of things to your home, or, streaming, or, advertising, or whatever. Okay. That was good for those companies. I don't think, but the reason why productivity has not increased in the last 10 years, because we didn't see what I call a diffusion of technology across the economy, right? We didn't see technology improve the manufacturing processes of industrial companies, for example, or energy companies, or healthcare, which is still an absolute mess with respect to how you get service, how you pay for it. There's so much waste, and education is just another black hole in that regard. But I'm optimistic that in this next wave, right, of capital investment, which won't just be on technology wares, but will be in, things like HVAC equipment, things that make the processes more efficient on the factory floor, new drilling techniques and then of course, healthcare efficiency in all ways, in all forms, how we deliver healthcare. And technology will be part of that, but there'll be other forms of capital investment that will help. And then this diffusion of capital investment across the economy can lead to much, much higher productivity for the average citizen, which is good for the economy and it's good for the citizen. Quite frankly, it's good for the individual. If you can increase your productivity, I'll give you a really simple example. People are talking about AI now, of course, this is the hot ticket. Yeah, I'm optimistic. I mean, I think AI is going to be quite interesting as well. And of course, then people say, well, it sounds terrible. We're just going to eliminate all these jobs. But that's not always a bad thing. What happens is, let's say I'm I don't know, pick a job where I need to process stuff. I'll take one near and dear to our hearts. So like say a financial advisor, and somebody has to talk to a lot of clients and deliver information to them. Well, if they have a artificial intelligence, tool at their disposal, they can all of a sudden now cover many more clients with a higher touch, and they can deliver probably a better experience for the client. And you could use that same analogy across many, many industries. So I think the one that people are really worried about is the creatives, right? So the creatives are like, oh my goodness, I mean, now there's this guy's making music with artificial intelligence and they're going to take my job away. Well, not really. I mean, as an artist, you could use that technology too, and maybe create 3 times as many, songs, or 3 times as many paintings in the same amount of time, or whatever your art form is. So I don't think it's all bad, is what I'm saying. And I think that anytime you can increase the productivity of your labor force, it's got to be embraced, with caveats that you don't want it to destroy jobs too quickly where people can't adjust. I think that's the risk, is that this stuff is all happening faster. And what happens is people don't have time to adjust. And we saw that in the last decade, of course, with the outsourcing of labor to China, which is over now for a couple of reasons I can get into. But that displaced a lot of manufacturing jobs too quickly. And so the folks who are working in factories in the US, you can't learn, first of all, somebody like me, 55 years old, I mean, can teach a dog new tricks, but sometimes a dog's too old to figure it out. I'm sure I can't really learn. I mean, if I got displaced, it'd be hard for me to reinvent myself. But I mean, that's one aspect. But the other aspect is that when you remove these really good paying jobs quickly, yeah, you can reinvent yourself into a lower paying. So I think that was a real problem. So we got to be careful that it doesn't happen too quickly. But those are some of the things that we're thinking about in technology spend that will help drive productivity in the future.
I guess the 2 big technologies that have been the most recent are blockchain and AI. Do those have the potential to enter into a new labor productivity surge?
Well, yeah, but for different reasons. I would agree. First of all, for every technology that takes off, there's 10 that fail miserably. Okay, that's the kind of the beauty of the VC world within tech. You get 1 home run and 15 losers, and you can still make a lot of money. So that's why it happens. That's why people go after it. I think you picked 2 that probably have probably good chance of surviving and adding value to the productivity of the economy. The AI example we just gave, and there's many other benefits too, potentially. Also some negatives we got to be careful about. And then, blockchain is still in its infancy. And of course, that can take on a lot of inefficiencies in the financial world where the spreads are too wide. You think about like stock trading, 1974, the, D-Day of deregulation, it used to cost, upwards of 60, 70 cents a share to trade. I mean, and now it's obviously, less than a penny. So anyways, I think blockchain will do that to many, many businesses that are, I think, fat and ripe for, price compression. So, and there's arguments for, efficiency of capital mobility. Now, of course, the governments are a little leery of that for obvious reasons, which probably won't get into that in this call. But, all new technology, okay, has negatives that come with the positives. And depending on how it's adopted and how fast it's adopted and what the regulations are around it and how they're put in place, which are always wrong to start and you got to revise them, will determine, how good it is relative to the evils or bads.
Yeah, it's interesting the development of blockchain, how people have lost focus on the technology and have gained focus on the cryptocurrencies that seem to be the centerpiece of all of the regulation. But it's actually a tiny part of the total blockchain opportunity. And so many companies are racing forward with blockchain technology to start trying to make their operations more efficient. And we're not talking about any of that. It's going to be interesting to see how that evolves eventually.
No, Bob, that's the boring stuff. Nobody likes to talk about the boring stuff, the plumbing. But if you think about the plumbing in any ecosystem, the plumbing is the most valuable piece. Like the electric grid. Think about that, right? That, by the way, that's a piece of plumbing that's broken. That needs to be fixed. It could really save a lot of power waste, as an example. But yes, I think you're right.
So a number of people we've had on have been talking about the relationship between inflation and interest rates over the next decade, 2 decades, with the credit, the total amount of financial credit globally at beyond records throughout history. How do you see that playing out? We were just talking about how high interest rates will allow for better discipline in the U.S. economy, and that will have its benefits. But how can these governments, do the governments have to keep rates well below inflation, well above interest rates for an extended period of time so that they can get out from under this debt as they have in the past?
Yeah. So, let's just cut to the chase on that one. I said we were coming to the end of financial repression. What I really meant to say was it's the beginning of the end, right? So you're not going to 2% real rates anytime soon because the economy, it'll break. And I think you had some other guests and colleagues perhaps talk about this issue. I agree with it, which is that, first of all, the government statistics are woefully accurate. Their accuracy is not particularly great, not because they're trying to cheat us or do anything, but like it's just, the headline inflation metrics have been proven to be somewhat inaccurate. Let's put it that way, understating real inflation. And if you're a cynic, you could say, well, that's on purpose because all the cost of living adjustments for things like Social Security and stuff, they want to keep it low, and that's how they financially repress us. And I think that there's some truth to that, meaning the real inflation rate is probably closer to 3-4, even before the pandemic, not 1-2, and therefore the real interest rate for the savers was actually worse. And I think that we're going to be in a period for at least 10 more years. Same thing happened in the 40s and 50s, by the way. We had negative real rates for the next 15 years. It was they did yield curve control. So I think that interest rates will go up, but they're not going to run away from us because they can't. Because if they did, then you will have a recession and then it's self-correcting. So I think the goal, like going forward, given how much debt we have now as a government entity, and all the off-balance sheet liabilities, which are kind of unwieldy at this point, we're kind of in a pickle. And there's going to be some adjustments, like retirement age for Social Security. It'll be people will fight it, but it's inevitable. Taxes are going up. Okay, collection of taxes, more efficient collection of taxes will go up. Loopholes will be removed. Okay, fine. And there'll be more taxpayers if the economy is good, meaning like 50% of the workforce doesn't pay taxes really net after all the distributions that they receive. That's going to change. They'll pay some. And I think the way to think about it is you have to think about, okay, well, what kind of, like, how negative do interest rates have to be in real terms to get out of the debt to GDP bubble that we have? And I would say it's probably something like -2, -3%. So that means, let's say we have, maybe we can get real GDP, if you get productivity up, could be 3, right? So 1% labor force, 2% productivity. Inflation officially is 3. They're going to raise that from 2 to 3%. Okay, so that's 6% nominal. But the reality is inflation is more like 4, 5, 6. So your nominal GDP is something like 7, 8, 9, or 6, 7, 8. That solves a lot of ills. If you can get revenue growth of 7, 8%, compounding over time. By the way, that drives your tax collections. And so it'll take, if we're successful, and I think the risk this time of us getting out of this pickle is harder than it was in the 40s and 50s for a couple of reasons. Like, we don't have to reserve currency anymore. The private sector is more over levered this time. People have, are smarter about, how to beat the system, right? That type of stuff. But I do think if we're going to be successful, it could take at least 10 years, maybe 15 years before we get debt to GDP back to, say, 80, 90%, something like that, which would be fine. If you can get back to 80% debt to GDP, that would be a really good goal.
Yeah, that 100% mark. It's hard to reverse it once it gets over there. So you got to run. It's got to run its course. How about the idea of prosperity, the happiness or the collective satisfaction of the population? How has that changed over time? What do you think about the next 10 years? Everybody's talking about how the political extremes, or the tension is building and things are likely to break. Are we still in great shape, even though we're feeling this tension? Is that a constant? How do you think about all that?
Well, I guess as somebody who's been on this earth for a period of time and has spent his whole life in the United States, I would say, yeah, in my lifetime, it's as bad as I've ever seen in terms of the partisanship politically, but also culturally. You don't want to get too high on your horse here, but I mean, it's pretty clear that the religious sort of backing, family unit, or sort of emphasis put on the family structure, and even education to some degree, has really faded. All the things that we grew up with in the 70s, 80s, and 90s of, hey, you do these 3 or 4 things and things will work out for you. People are challenging that view now. They're saying, I don't want to do that. I don't want to do that drill. Okay, I want to do something else. I don't like that path. And that sort of stress in the system, and you have people holding on to the past and what worked for them, and then you have younger people saying, well, that doesn't, we don't want to do that. Okay, and so you can't just put those people in jail and say, okay, well, we're not doing that, and we're in a democracy, so you need to listen, and we need to have conversations. So I think we're not having conversations yet. Instead, we're yelling at each other. And just to be clear, that's the last time that the system was this polarized was the 40s. So and this goes back to the cycle, and that sort of cycle history. And every 80 years, there are some chart cycles and cultural cycles. About every 80 to 90 years, we go through the same thing we went through the 80 or 90-year period. So we're right in it now, right on time, by the way, exactly on time with when it should be happening. And so the optimists would say, and I tend to be more glass half full, would say, well, I still believe in the system. I mean, if you really hate America so much, go try living somewhere else, because, I got news for you. You're not going to be happy with, basically your choices. Not many choices to be had. So, this country still does offer, for people who want to take advantage of it, okay, and do the right things, you can generally be very successful here, both, from a happiness standpoint, from a financial standpoint. Okay. Some people would say they're one and the same. I would say they're not the same at all. But like, no one's stopping you from choosing who you marry, where you live, what kind of occupation you're going to pursue, what school you want to go to, what religion you want. I mean, I don't see there's no constraints on that right now. Some people will say, oh, we're being suppressed. You're not being suppressed. Okay. There's a little more agitation perhaps. But for people who want to choose what they want to do, I think that's still there. So that's really important. If that was really changing in a way where I felt like the state was truly imposing on my rights, then I would be concerned. So I think this freedom of speech thing is one area where I'm a little concerned. I think it's really good what's going on with Twitter now with Elon. I think that's really important, because you can't just cancel people because you disagree with them. You can cancel people if they're saying stuff that's, truly damaging, and they're trying to like rile up people and stuff like that. Bad. But hey, if I disagree with you, Bob, I mean, maybe we can have a debate about it as opposed to just yelling at each other. So we're not there yet. But I'm hopeful that we can get there. And ultimately, I don't know what the new world looks like. It probably doesn't look like the 50s. Okay. But it will look different than, say, the period that we were in the 90s or 2000s. We're probably not going back exactly to the way that was, but we need to get back to a place where we're working together and working and rowing the boat in the same direction. And I don't know what it's going to take for that to happen, but unfortunately, it probably will take some crisis where people say, okay, we've gone too far now. We have to now work together. And I don't know what that looks like, but it's probably sometime in the next 3 to 5 years.
Yeah, I think of the word tolerance, and there seems to be a difference. There seems to be a lot more tolerance still in the community level, as there probably is throughout history, and less on the society level. And I think that's still a core element of health in our system. How about the banking system? It's certainly, with the Silicon Valley Bank failure, it's brought a lot of attention to the whole concept of how banks, what their role is in the economy, and that it's certainly more fragile now that money can flee quickly, particularly if you emphasize those types of accounts as a bank management. And with an inverted yield curve for the time being, this business model seems to be very tricky. What do you think about the banking system over the next decade?
Yeah, I mean, I think it's a very tricky question, because I think things have been evolving for a while. All right, so let's back up a second. After the Great Financial Crisis, obviously, we put in more strict regulations for large banks. And at the time, I think it was 50 billion in assets or more. These banks were heavily scrutinized for good reason, because of what happened in the housing crisis and everything else. They wanted to make sure the system was secure. And I think they did a really good job, quite frankly, of doing that, because some people say, well, the banks got bailed out. They did, but they paid back all the money they borrowed, or were used to get bailed out. And the government actually ended up making it. That was a good deal. Okay. Problem is that they took their eye off the ball with respect to smaller banks. And at the time it was less than 50 billion in assets, and they changed that rule to 250. But either way, whether it's 50 or 250, that was a mistake. You needed to maybe not put as of harsh regulations on those banks, but they were basically unregulated. And that's kind of surprising when you really think about how that worked out. And look, hindsight's 2020, right? So, but that's a mistake, and they got to fix that. So that's number one. Number two, the shadow banks, right? These are guys who do private credit, private equity, et cetera, who are totally unregulated. They were able to take share during the post-financial crisis period because the larger banks were no longer able to compete in these riskier areas. So that gave them free reign and so they've become enormously large. And so that I would say both the smaller regional banks and the shadow banks are, now a little bit unwieldy. All right. And we don't really know how that's going to get put back together, kind of going forward. We know regulations are going up. Okay, but we don't know how they're going to be employed, who they're going to be employed on, and what that's going to do to lending standards and the velocity of money and credit. So I think in the near term, my general view, now this is my initial reaction right after Silicon Valley failed. The first note I wrote was over the weekend, and I stand by that. I think that is the right conclusion, which is that the overriding issue for me as an equity investor or risk asset allocator is that the availability of credit is going down in the short term. I mean, full stop. That's very simple it's very hard to argue with. The question is how much is the availability of capital going to go down? How fast is that going to be? And can that lead to a recession like immediately? And I think the answer is, well, the risk of that's gone up. I don't know if it's immediate, but so that's how I think about it. And then, post
how well do you think the Fed's able to monitor that?
The Fed itself?
Yeah.
I don't think they can. I don't think any of
Yeah,
them.
I mean,
that's the problem, right? The Fed
could be much greater than we ever thought. Yeah, so it just throws in a whole monkey wrench that we weren't expecting before. Yeah.
Right, but okay, but at the same time, I mean, it's not like this is a surprise, right? So I mean, this is what the Fed was going for.
No. Yeah, but I guess my point is the Fed could massively over tighten even more than they think they are, because they have now a new dynamic that they're not able to monitor.
That's right. And but look, okay, but you have to understand that the Fed always over tightens. I mean, by design. Yeah. So that's, I mean, and they stayed too loose for too long. I mean, that's just they're always reactionary. So I think the way to think about it is the Fed was always going to over tighten, and this just now brings that risk forward.
Even forward, yeah.
Correct. So now I think I think we'll have a recession this year, and I think it's soon. We're already seeing it in the jobs data now in the last couple of weeks. We're seeing which just got revised, which is kind of crazy. But
yeah, it showed it was even worse than we thought. Yeah.
Right. So I think it's already happening. I mean, we're already in an earnings recession. That's our expertise, and we think that's going to get worse. That was already on a bad trajectory. So I think this is just going to bring it all to a head. Now, to Bob's question, though, which is more important for intermediate term, is okay. Let's say we have a recession. Okay, how fast can they get these regulations in place where the system is maintained and not destroyed? Because you're going to need the banking system now even more than ever to get the economy going again, because if they can't do QE again, right? That's politically unpalatable. And so my view was always that they were going to use the banking system because it was so good, right? It was in such good shape, and it was protected, that you could do direct lending via the bank system when the time came. But now it's possible that that's been impaired. That's my biggest concern. Is that I'm not sure what it looks like on the other side of this recession now, whether it's this year or next year. You know what I mean? And can they actually the velocity of money may be permanently impaired. And if you can't do QE and use the Fed's balance sheet, then how are you going to actually get this thing restarted?
You also throw in with the banking sector, we have commercial real estate lending that is going down, but a lot of those loans might go bad, but it really has nothing to do with the economic cycle. It has everything to do with, because of COVID, we don't go to the office anymore. So we have too many, so there's just so many other dynamics that to slow the US economy.
Sure. I'm not as worried about the CRE thing in the short term, because that's a mark. It will be refinanced. I mean, I wouldn't necessarily.
Yeah, it takes a long time to roll over, but you're not going to be making those loans to stimulate either.
What it really leads to, though, is it just leads to lower returns for the investors in those properties. Okay, that's not the end of the world. That's not going to take down the whole economy, but it's just it's a crowding out. Okay. Because that money has to be, we only have so many things we can invest in, and the question is, do you really want to put some of our capital into, tier 2 office properties that are?
That's a great point.
Not that great. So I think what will happen is there'll be giant write-offs. These properties will end up being redeveloped over the next decade for perhaps better uses. We'll see.
I'm curious to watch how quickly deposits at banks leave to find higher rates, and how quickly banks have to adjust for that. But the financial health of banks from a profit perspective is definitely impaired going forward. It'll be very interesting to see what the banking function, how well it functions. I also think that until the new regulations come in, you're going to have what you have whenever there's regulatory uncertainty. You're going to have a pretty big break on activity there too.
Well, that's right. But think about it this way too, Bob, which is you're going to get it's basically a reallocation of money from banks to consumers. Okay, so it's not all bad. I mean, it's going to be bad for the banks who are not efficient. And so I think you're going to see a lot of, rationalization. Okay, so there'll be a ton of consolidation in the banking industry. The bad operator stocks will not do well. The good operators will take share, and I think it'll be fine. But the thing that's being missed here is that I think the number is something like on the order of 30 or $40 billion of incremental interest income for consuming. You think about the amount of deposits that were earning zero. That's the most shocking thing to me is how slow people were to move their money when you were getting. I understand if you're getting 1%, it's like, who cares? If you get 5%, in a money market, it's not hard to move. And so I think that's going to persist, and that's what's going to. Like whether my deposits go from my bank to another bank or they go from my bank to a money market fund, it's no different. I'm losing deposits.
But if it goes to treasuries.
That's right. And so this is the whole money supply question. So what'll happen is, obviously the Fed will be cutting rates at some point. Okay. And when the time is right, they will cut rates, and that will solve this problem. But hopefully they don't cut them back to zero. They cut them to 2, 3, I don't know, something like that. And by the way, banks have to pay 2% for deposits. And that's not a bad thing because, I wouldn't mind getting 2% on my cash. It's not so bad. Getting 5 now, which is great, but I know that's not gonna last forever. So, but that's a good thing for the average Joe or Jane.
We've touched around it a little bit, but let's talk about what an end of the bear market looks like. Because we're probably
like a scary costume on. I think I guess the real question, Bob, is did we already have it? Did we see the lows in October? And I would say in October, the majority of people were, this is not the bottom, but that's why we went tactically bullish for a few months. We thought it got too bearish, and we traded that pretty well. And then we turned, bearish again in early December. And, we went down. Now we're basically trading back to where we were in early December. So we haven't done much, except we've rotated from, I would say, old economy stocks back to the tech names, which people, prefer, because that's what they can get more excited about that. Okay, fine. But nothing's really happened. We just sort of chopped back and forth in the last 6 months since October. And I personally do not think that that's how bear markets end. Bear markets typically end with, a little more fear, a little bit more panic with respect to where valuations are. And this is very specific to the way we look at the markets, which is it would be unprecedented, okay, for proper bear market, which is being driven by earnings recession, which is our core view, for the equity risk premium portion of the PE multiple to not have spiked. And what I mean by that is all of the bear market to date has been a function of multiples coming down because of higher rates. And the equity risk premium is actually lower today by a significant amount than it was at the beginning of the bear market, which is kind of crazy. So in other words, what I'm saying is that no time in the last 12 months, even back in October, did the equity risk premium ever exhibit any concern about growth. And that to me means it can't be over if, and it's a big if you agree with our earnings forecast, which is, more negative than the consensus. But I would argue that I think the consensus is kind of going to move towards that. We'll see how that goes, right? I think that's the $64 billion question is, if we're right on earnings, then it's not over. If we're wrong on earnings, then we probably made a low in October of last year. But that also means that we're probably not going to get the relief from the Fed that is necessary for the next cycle. Yeah. So I don't see the bull case from here for US equities without a recession. That sounds perverse, I know, but like the recession will allow the recovery, the cycle. And without that, there's no reflexivity. There's nothing for equity investors to get excited about.
Yep.
So I think it ends. I think it ends
how-
with much lower multiple than what we saw in October. Not much lower, like 13, 14 times as opposed to 15.5 times. But the numbers are lower now too. So that's somewhere. It's new lows. It's somewhere between 3,000, 3,500. Fine, pick your range, and it's probably sometime in the next 3 to 4 or 5 months if it's going to happen.
How much lower are your earnings forecasts than consensus right now? And what are the sentiment indicators looking like to you, or your conversations with clients?
So as far as our earnings go, we're in the 180 to 195 range. 195 being kind of our, somehow we skirt a recession, which is our economist base case, but it's not good growth. Okay. 0% growth, basically, not a recession. And then 180 is like a proper recession. Okay, fine. That would be for this year. And the street consensus right now is 225. So it's a big delta.
Yeah, 15%.
I'm sorry, it's 220. 220 is the number for calendar year. And I would say the buy side is around 210, 215 based on my conversation. So the buy side is bearish on earnings, but they're not nearly as bearish as I am on earnings. And because of that, their sentiment isn't nearly as bearish either. They're sort of like, nah, I'm not excited at the moment at these prices, but we're going to muddle through and I can pick stocks in this environment. And, I want to own these 10 companies or 5, whatever they are, they're concentrated positions. And I think that's how most, institutional portfolio managers are treating this right now, which means if I'm right on the earnings recession and potential economic recession, then there's going to be a rude awakening. So we'll see.
Yeah. And what are the sectors that are representing the largest declines in your
Well, yeah, our model isn't that prescriptive because it's really a top-down model, but I would tell you it's the areas that haven't seen the revisions yet. So financials is an easy one. I mean, I think, we're going to see big revisions there this quarter. That's 16% of S&P earnings. It's about 35, it's about $35 of the 220, if you will, 225. That can go down quite a bit. So that could be $5, $10, $15 of risk easy right there. Industrials have not even begun to see, their forward estimates are still at the high. And I should have said this at the beginning, the peak earnings for S&P on a forward 12-month basis was 240 in June of last year. It's now 225. And so it's down about $15. Industrials haven't come down at all. So that seems a little crazy. That's a big part of the S&P earnings. Technology is mixed, right? So semis have seen a big reduction in earnings so far, but software and services, internet have not seen as much. Comm services have, those would be the big internet advertisers. Those have seen big revisions down, but there's probably more to go. And let me just spend a minute on this. I think it's important. So technology, the reason why people are excited about technology stocks right now is because the sort of view is that, well, tech went through its recession last year, right? And they clearly were a victim of their own success, right? They had COVID, they were the big winner because we had to digitize the economy. There's a giant pull forward of demand for everything from PCs to handsets to software, you name it. And they over-earned dramatically. And so obviously that came home to roost, and that's where the revisions have been pretty significant already. But the real issue was they were over-earning so much that they haven't really seen the pullback yet in top line. It's been mostly margins. What happened was they over-invested, thinking that good times were never going to end, and they overhired. And that's why we're seeing, the companies now are talking about year of efficiency, because they finally caught on to that was our theme, by the way, before they started using it. And they said, because they realized that the market was paying for efficiency. So they're firing people, laying people off, whatever you want to call it, cutting back on costs, and they're being rewarded for that. So now people say, oh, well, these tech companies are ahead of it. They've done the cost cutting, and now they're into a new cycle. And I would caution against that. And here's why. What tech experience was more micro, right? Think of Y2K and what that did. It was a giant pull forward, and then COVID was like a Y2K junior. So that's the first recession. Then the second recession is the economic recession, which will then hit them on the top line. So I think you got to be really careful assuming that tech is done with its recession, because they're not economically insensitive. They are the economy. I mean, you can't tell me that if we have an economic recession that these companies aren't going to feel it. They are. So they're not going to feel it any worse than industrials or financials or others, but they're not going to skate through if there's an economic recession. So that, basically what it comes down to, Bob, is you have to take a view on whether there's going to be a true economic recession, a labor cycle, and a surprise on the top line.
Yeah.
Our view is yes, and everybody can have their own view about that.
How about the debt ceiling? How worried are clients? How worried are you? Is this just a temporary one-time thing that no matter how it gets resolved, the markets will be where they are on the other side of it? Or is it serious?
Well, depends on what they do. I mean, I would say this, that it's not top of mind yet because it's not close enough. But as we get closer to, say, early June, mid-June, it'll take all the oxygen out of the room. I mean, it'll be like the banking situation is today or was 2 weeks ago. It'll just be everything. That's all they're talking about. So I don't see a path. I'm not the expert on that, but our guys who are experts are like, nah, I don't really see them inoculating us from this risk before before the disease arrives. Okay. So unfortunately, I think it's going to be a tough summer. No matter what your view is on the economy or anything else, it's just going to be one more risk variable that we got to deal with. Now, ultimately, I believe they probably will, increase the debt ceiling and we'll get through it. But, like you remember what it was like in 2011. I mean, it's messy. And it's not, and it's Washington at its worst. So, and both sides are, going to point fingers, and it just makes the whole thing painful to listen to. Yeah. So I don't have any confidence that it's going to be resolved neatly, but I do believe that, like everything, whenever the pain gets bad enough, they come up with a solution. And then I think the question, which you asked the right question, is this a structural problem? Like, can they come up with a solution that is like manageable, that where, the bond market doesn't go crazy, they push back, maybe Moody's downgrades us another notch. I don't know, but, and I think the biggest issue is all these people we've been borrowing from around the world for the last 50 years. They basically say, I've had enough of you guys, and we're just, we're taking our money out. I don't know. That's the biggest risk. That's where it becomes really nasty. And I think it's a tail risk. I don't think it's 50%, but I think it's there.
Yep. Well, and you touched on the reserve currency idea earlier. It's actually quite fashionable in the last couple of weeks. People tossing around the idea of the U.S. going to lose the reserve currency status. What do you make of that?
Well, I would say, first of all, using our cycle hat again, it's on schedule. 80 years since we became the reserve currency, it's somebody else's turn. Now, I don't see the natural heir. So it's not like, there's an heir apparent waiting and the dollar is going to go the way of the dodo bird. Okay. But we're going to lose some of that privilege. And I mentioned it before, like I think in the cost of borrowing. I think the currency will weaken. It won't fall out of bed, but it'll weaken, and that's, it's not great. It's inflationary in that regard. So I don't think we're looking at a situation where the dollar crashes. It's impossible because, the world is still dependent on dollars. There's still too much dollar-based debt. I think what happens is it's just, the biggest driver of this trend is that every major country outside of maybe our NATO friends is basically saying, well, this dollar-based system sucks. It's bad for us. So let's try to get off of it, right? China's been trying to get off of it now for 10 years. We kicked Russia off. Maybe people say that's a good thing or a bad thing. I think it's a dangerous thing. Not because I'm a fan of Russia or Vladimir Putin, okay, but because I think it sends a terrible message to everybody else that if we don't like you for whatever reason, now maybe in this case it was justified, but if I'm XYZ country, I'm like, well, maybe they don't like the way I the way we practice, the way we live. So, I just think that they almost have to diversify themselves from that. So what we're seeing is, the biggest commodity traded in dollars is oil, obviously. So now China is, basically buying oil in rubles or yuan. Saudi Arabia is doing the same thing. They're selling now in yuan. India is buying in rupee. And they're saying, like, we don't need the dollar for this, and that's a big step. So I think where I come out in the whole thing is, I think we had peak dollar in 1999. If you actually look at that was peak US, by the way, 99, 2000. And if you've been around as long as we have, like in 99, and not just because of the tech bubble, but like it was good, man. I mean, like your dollar went a long way, and it was easy to get ahead. Jobs were plentiful, they paid well. People, like the machine was rolling. And I think that was the peak for US hegemony and the dollar and just basically US in general. And of course, the last 20 years has been kind of a slow slide. But it's not like we're going to like this. I mean, the US is going to be very important for the rest of our lives and probably the rest of the history of the world. Okay. But it's not going to be as dominant. That's clear. The multipolar world thing is for real. There'll be three sort of, hemispheres, and, individual countries can choose which one they want to align with. And it won't be as easy. That's part of the 40s, 50s thing too. That's the one thing that's different, though. We don't have that benefit. So getting out of this particular financial repression era will be more challenging because of that dynamic. It will be probably a little bit more inflationary and not as prosperous for the average person as the 40s and 50s. I mean, 50s was probably the most prosperous decade of the 20th century. And for the average person, it was phenomenal. I don't think we're looking at that. I mean, we're probably looking at something in between.
We have a question about precious metals, commodities, oil in particular. How attractive are those as investable assets?
Yeah, we like them all. I would say now, obviously going into, if we're right about the economic slowdown and potential recession, I mean, the base metals and, kind of economically sensitive commodities are not going to trade well in the next 2 to 6 months. Okay, fine. But intermediate term, we're very constructive on, I would say, of all those groups, materials space in particular, base metals, because we just don't have the supply. We haven't invested in the mines and the things that we're going to need to do all these things that people want to do. Energy, or oil in particular, and natural gas even more so, we have the reserves, and they're plentiful. So it's just sometimes they get constrained, but over time, it should still be a scarcer asset than it's been, but not as good as, say, copper or some of these materials that are going to go into batteries and things like that. And then lastly, precious metals work really well, and then they don't work at all for 5-10 years. Right now they're in gear, and that's the area we've been most bullish, because this is when you want to own precious metals going into a recession. Now you got to be careful in the near term, because if we go to recession, what happens is real rates shoot higher as break evens collapse, and oil or gold will not do well for a period of time. I don't think it'll last very long, maybe a month, 2 months. But if you go back and look at March of 2020, if anybody has a Bloomberg or whatever you want to look at, you'll see gold got killed in March of 2020 because real rates shot up. I don't think it'll be that severe this time, because we're not going to have a pandemic hopefully again. But you have to just be aware that gold's been on a pretty good run here. I wouldn't be like putting a full position at today's prices. I'd average in over the next, say, 2 to 6 months. Or if you own gold or silver or other precious metals, just be ready for some volatility here.
Yeah, those downdrafts can be pretty quick and deep when the real rates start shooting up. Well, Mike, it's great to see you again, and thank you so much for doing this. And I thought that was a really fun conversation.
I enjoyed it. I did most of the talking, so maybe I shouldn't say that. But anyways, it's great to be with you guys. Happy religious week for the Western world. This is the most religious week. So for those who practice and obey, have a great weekend and enjoy.
Yeah, you too. Great. Take care.
Bye-bye.